It's me. Y'all on level 1, I'm level 3. Pounding on the table for my team. Every night I flex, I'm making big moves. That's a big move. Big money, big move.
What's going on, buddy? I start, man. What you see today? Just a quick overview, some observations. I'd love to just let you rip, kind of off the dome a little bit.
Sure. Yeah, so, today was a bit of a choppy day. I'm not sure how many may have listened to my podcast from the weekend, but I was kind of expecting this week might be a bit more choppy, and certainly no disappointment there. We didn't see a big rise in volatility, but underneath the surface, there was a lot of sort of sloppy seesaw action in prices. And as we got closer and closer towards the close, we saw some pressure building on the sell side. And then as we got to the close, there was, let's see here, about a 2.8 billion imbalance to the sell side. That was one of the reasons the market got faded so hard into the close there. So, from the way that I was trading the tape today, I was kind of just being very clinical with short time frames, Ichimoku on 5 to 15 minute time frames. And I was trading the tape today. I was kind of just being very clinical with short time frames, Ichimoku on 5 to 15 minute time frames, and just basically trading trend changes. Longer term, S&P, NASDAQ, they were in uptrends. Things like ARK, IWM, they remain in downtrends. So we're kind of in a bifurcated market here. If you look at the defensive names, they had a strong bid today. In fact, the low volatility large cap factor was really the only factor that had a bid. And then when we look at the sectors today, just on the close, I'm just going to sort these by change on the day. Biotech, utilities, consumer staples, real estate, healthcare led, and then energy, retail, semiconductors, regional banking, and home builders bled. And actually, home builders kind of closed out on the low of the day. So it was a day where there was some de-risking and some hedging ahead of the Fed and some of the other event volatility drivers. Remember, this is a week with multiple central banks around the world that are meeting and maybe announcing policy changes. And then we also have a lot of econometric data. There's global PMI data, and we have RPI data coming out. So there's some catalyst there. And then, of course, on Friday, we have quad witching. So this is a week that is likely to be more volatile. And even if you don't see it at the index level, like the S&P wasn't down 1% today, but if you look underneath the surface in some areas, there was still a lot of bloodletting. And then in other areas, like in these defensives and in certain names, there was actually some good strength. So it really depends on how you're positioned as to how you do on a day-to-day basis, because what's in favor has been changing a lot. So, what we're really looking for going into the rest of this week, just focused on the U.S., is a PPI that's not too hot, something that suggests that maybe, producer costs are starting to come down, which is something that I suspect will be a bit of a theme in early 2022 if it doesn't start here. I am starting to suspect some of these inflation reads are at or close to their peaks. And we would want to see a Fed that is, if they're going to be more aggressive about their taper, they're not going over an increase of $20 billion a month. I mean, ideally, it'd be 10 to 15 if they're going to do it at all, and is not signaling more than 2 to 3 rates. That would be ideal for bulls here, because I think if we get anything much more aggressive than that, it could create some problems for risk assets. And then on quad witching, leading up to quad witching, we're probably going to have some more volatility driven through options. Some of it might be upside volatility in the names with lower floats that have options that are easier to push around the price of the underlying. You see some of those runs happening on bid up days where we have a constructive tape. So if we have a green day, Wednesday, Thursday, Friday, you might see some more options driven speculation in some of those rate sensitive names, biotechs, et cetera, that have really been in play for traders. Longer term, markets remain in uptrends, but 2022 is looking like it's going to be a year where later cycle plays are probably in favor. So, if you haven't rotated anything in your portfolio and you are trying to be a full cycle investor that's diversified, look at the sectors that are leading over the last week, month, quarter, and start to figure out whether you want to allocate into those sectors, as a generalist into the ETFs or into specific stocks that are leaders in those sectors. To me, I've been keeping a close eye on things like energy, financials, materials, industrials, even some of the defensives like utilities, because I do think that there's some need to kind of reconstruct the portfolio for the later part of the cycle, achieve both a greater buffer against volatility and then probably better returns in what's going to be a choppier year ahead.
Dude, I don't know how you just rip all this stuff, man. It's incredible, man. Thanks for sharing all your knowledge. I pinned your tweet I think it was a podcast you recorded yesterday or very recently on your thoughts ahead. So if anyone hasn't checked that out yet, definitely do. I see we have Luca joined. Luca, what's going on? Can you hear us?
Yeah, I got you loud and clear.
What's going on, bro? I just started with MM, just giving a quick overview of the markets. He kind of just gave a good glance into what's going on from overall market health perspective, macro indicators, and some of the state of certain sectors. I think you're doing your daily wrap right now, right? Luke, anything to share? Any trends or things you saw? And I was talking to KT a little bit ago, and we said we were talking about Walmart yesterday, and those calls are up like 130%. So it's pretty ironic that we were literally just touching on that like yesterday morning in our spaces. With that though, anything we say or talk about obviously is definitely not financial advice or should not be conceived as such. Nothing is buy, hold, or sell recommendation. These are just our personal thoughts. But if anyone has any questions, feel free to request. We will be taking questions. But Luca, handing over to you. Anything you've seen today or any observations?
Really just more volatility, and I'm not really surprised by that. We're going into this week, and we have this big Fed meeting here, and just a lot of volatility surrounding that. So I'm not overly surprised with what we saw today. You saw a lot of names this morning fade. So they opened up, and then they, just slowly kept declining throughout the day. I'm not real surprised there. A perfect example, for instance, is like Qualcomm. You saw it moved higher this morning, made an all-time high, and then immediately shot back down. And you saw that with a lot of names today. So not quite surprised on that. I take a look, what's going on in the world, news-wise, media-wise, related to the market. It seems you've had, a little bit of that COVID-19 fear pop back again, carrying over from last week and the week before. You're seeing more of this Omicron spread in the UK and more spread here in the United States. So that could have played a role in some of these travel-related names. You take a look and you look at these travel-related names, and a lot of them got nailed today. So I think that's probably mostly COVID-related, not real surprising there. So just a lot of volatility overall, a lot of choppy action, and that's really what we've been.
Sorry, Luca, did I mute you by mistake?
I think he may have dropped out.
No,
Maybe
he's there.
Okay.
I clicked mute by mistake. I was trying to accept someone that wanted to speak.
Okay.
That was my mistake. I hate how Twitter has the mute button and the request to speak button right in the same location. So if I miss, like if the person requests to speak and then they leave, then I click like the timing of it. If it's off by a second, I click mute. Then it's horrendous. But Maggie, I think it was you that was requesting to speak. If you please request again. I'm sorry about that. Luca, go ahead.
Okay, I'm back. I drop off. I was looking at the charts while I was talking, so I didn't really see where I actually fell off. Anyway, overall, to summarize what I was saying, more volatility carrying into this week. Not surprised there. It seems to be an indecisive market. We have still a lot of focus on the Fed this week. I'll be keeping an eye on what happens there. Some of those COVID fears are back with the spread of this Omicron variant in the UK and in the United States. So you saw those travel names move to the downside, but that's really what I've been eyeing. I'm finding some opportunities in the value names, but not terrible amount, nothing crazy attractive. So still, mostly cash, just waiting to see what this market does and for the waters to clear up a bit.
Awesome, good stuff. Before we get into questions, I've said this in previous spaces. We're going to be doing these a lot more often. It's awesome to get MM on the mic. I love hearing from him. Of course, you have Luca and me, who've been on all these as well. Our next spaces is on Wednesday. The flyer is pinned above. Wednesday at 6 p.m. If you don't get the alerts or if you're not seeing winners, because some of these are spontaneous, some are planned. Like today, we just spontaneously hopped on. So give the panelists a follow. We're going to be doing this a lot more frequently, and we want to share and contribute our thoughts. And if you enjoy these, share it, retweet it, so we can get more listeners to help kind of all of us, right? That's the goal. We're trying to build this community of pounders. So you got Pounding the Table, you got myself, you got Mark, it's me, him, and you've got Luca running with the money. So I think Akib, you had a question. What's going on?
Hey, what's up? Again, Rahul, I appreciate you putting these on. These are always super helpful, so that's really awesome. So I just wanted to give you a shout out for that. My question is...
Appreciate it.
Yep, definitely. So my question is, a lot of volatility in the market, definitely, and everyone's waiting for the Fed, right? Like, interest rates are going to increase or not, or waiting for them to, what's their take on inflation and tapering? I guess best case scenario, what is it that you guys want to hear from the Fed to signal maybe like a bull or a good end to the year? Like what it is, what do you think that you want to hear that will help the market? And I'll just wait for your question. Thank you.
Thanks. Yeah, that's a good question. That's probably the golden question of the month. So, MM, I don't know if you want to take that. I have some personal thoughts,
Sure.
but MM, I'm
I
sure
mean,
probably has the technical, macro, everything all in one. He'll give you the best answer.
thanks, Rahul. So with the Fed meeting that's coming up, we're kind of at an important juncture for this cycle. We're deciding as to how much is really left of the bull market, and the Fed has a lot of influence in that because they help to set the narrative and some of the underlying policy, which creates both the rate environment on a nominal and real basis, as well as sets the sentiment in the bond market, which helps to shape the yield curve. So I think that what the market would really want to hear to be more Goldilocks is a Fed that is either not accelerating the taper or is doing so in a marginal way and is very wait and see. So they say, hey, we're going to do 10 billion a month or nothing, and then by the next meeting, we're going to reevaluate and see where we are on this. We might accelerate, we might hit the brakes a little bit, but we'll see what makes the most sense given economic data. I think the market likes a data-driven Fed, and then it makes the macro kind of weird in the sense that bad macro ends up being good for risk assets because it means that the Fed is more inclined to potentially be patient. So I think what the market would want to see is Jay maybe not pivot dovish, but maybe just shy a little bit away from being, as he was perceived hawkish recently, a little bit less hawkish with his tone. Another thing, and this is something that Powell has acknowledged, and I believe other Fed speakers have acknowledged, is they're not so confident as to how efficacious it will be tightening policy to reduce supply chain driven cost push inflation. And that's a problem, right? Because if you're a supplier or if you're a manufacturer or if you're somewhere else in the supply chain, a reseller or so forth, and you are a company that carries a reasonable amount of debt that needs to be refinanced, and you're in a rising rate environment, that means your overhead's increased, and at some point you're going to have to pass that on, which creates another type of inflation that can enter the pipeline, which eventually hits consumers. So the Fed is walking a bit of a tightrope here, because the last time that they really had to face inflation was before any of the current members were on the board, right? Late 70s, early 80s. That was the Volcker era. He got inflation under control. He pretty much destroyed it with a very aggressive rate policy and tightening liquidity. But that was demand-driven inflation, and that was also a completely different population demographic of largely very young people, starting families, rising wages. This is a little bit different. And it's not entirely different. There's certainly some demand drivers for the inflation, but I feel like a lot more of it is a bit of a COVID hangover and some of the lingering supply chain issues that are still online and still causing problems. So I think the Fed is aware of that. They've expressed their awareness of it to us, so they may consider that when they're making policy decisions. So I'd be looking for, a not too accelerated taper, if any at all. I'd be looking for them to do 1 to 2 rate hikes in a sort of dot plot consensus. And I would want Jay Powell's press conference to be one where he's more aware of the sort of tail risks from things like the Chinese real estate debt crisis, potential variants of COVID, whether it's Omicron or something else. Omicron seems to be pretty mild, but there could be something else down the pipeline. Just give us a sense that they're a little bit data-driven, that they're still not 100% on track of saying, inflation is our primary target. I think that would unleash some bull animal spirits. On the other side of that, the bear case would be that they're more aggressive than the market expects, and we get hotter data and other central banks that are also more hawkish. So, I think the reality will probably come somewhere in between. I'm not so sure that Jay Powell is going to want to pivot and then kind of unpivot. It could be seen as a credibility issue, and they're already having that kind of drawn into question here. So I think, if anything, it's probably closer to consensus, if I had to guess. So maybe a $15 to $20 billion taper, maybe 2 to 3 rate hikes for 2022, and maybe a sort of initially an unhappy market reaction that kind of turns more sanguine as the week goes on. And part of that has to do with just the way that we have event volatility drivers that unwind as time goes on as well. But this is quad witching week, so it's going to be a little bit goofy, a little bit bumpy. The best thing that I would suggest is, if you're nervous, if you're having trouble sleeping at night with what's in your portfolio or the risk involved, consider de-risking, or consider, if you're an advanced investor or trader, some hedging strategies. Because no matter what, none of us have a crystal ball, and really only the people at the Fed and maybe some very other privileged people really have any idea as to what's going to happen on Wednesday. All we can do as investors and traders is model for probabilistic outcomes and then kind of come up with what we would do in that scenario.
Yeah, no, to add to that, I actually have a thread pinned above. I ran a decent amount about this in the past week or so. This thread is on the QE, which really goes back to 2009, depending how far or how long you've been investing. I mean, you might be familiar with the financial crisis, and that's kind of what really started, Fed taking on more on the balance sheet, and this whole tapering, tightening, rate hikes has been really in been going on backdated till then, right? Because of the response to the financial crisis, and then you had 2013, Bernanke came out and kind of shocked the markets a little bit. 2018, something similar happened in December in terms of a bit more hawkish Fed, and then now you're seeing it again in the past few weeks. As said, I think coming in right in between might be probably the best case scenario because correct me if I'm wrong, I feel like any potential worse outcome than that kind of seems to be, I mean, growth stocks are down 40, 60%. I mean, I would imagine the market's already playing this volatility ahead of the game, kind of like you said, de-risking in advance. So yeah, I think 2 to 3 rate hikes and then keeping the taper 15 to 20 billion would be in line, I would imagine. I think his tone and just the way he speaks things is definitely important as well, because people are going to be looking not only what he says now, but what he's going to talk about for 2022 in general, right? So I do know last time the November comments were, I think, caught everyone off guard, just got a lot more hawkish, very suddenly, almost like a 180 out of Matt, I think it was. So yeah, but do you see, like, in terms of the flows? I mean, I don't know if you can comment on that. I feel like some of this is already priced in, I would imagine, right? I mean, how much lower do you think we dump? I mean, he would have to go pretty more hawkish than he already has, right?
So it's a really strange dichotomy that we have in this market because there's such narrow breadth at the index level. If you're just looking there, it looks like everything's pretty healthy. Oh, look, the S&P is only 40 handles from an all-time high, or if you're 50, 60 handles from an all-time high, and Nasdaq is in spitting distance. But then you look deeper down, you see where the Russell is, you see where the Russell 3000. Something like half of its components are down 20% or more. So there's like a stealth bear market going on here underneath the surface. There's increasing fragility. And when you look at what's leading the market up, it's a smaller and smaller group of stocks. And that's something to be concerned about. It doesn't necessarily mean that we're immediately at risk of a major correction or a crash. But it does mean that what's driving the market up is just a handful of companies. And there were some studies about this. I think it was, the big five mega caps accounted for something like 36% or so of the Nasdaq's gains this year. Maybe it's even more substantive than that. Of course, Apple's 11% of the Nasdaq. So looks can be deceiving. When you look at equal-weighted S&P and equal-weighted Nasdaq, they don't look quite as healthy as the cap-weighted indices. So the big takeaway here is really, we have two scenarios that can play out. And if you look around the world, emerging markets don't look so hot either. So there's some idea that perhaps we start to see a catch-down effect, whereas the majors start to catch down to some of these underperformers, and the underperformers maybe consolidate, go sideways a bit. That's certainly a possible scenario. The other scenario, and we're just talking about the bearish side, not what's ultimately going to happen, but sort of what could happen if we have a more meaningful drawdown. The other scenario is that we kind of have a continuation, whereas the indices do get drawn down, but so do the rate sensitive stocks and the high debt stocks and the high beta stocks with it. And that's not out of the realm of possibility, even withstanding the haircuts. It really all has to do with market sentiment. If people really think that we're going to have an aggressive Fed that's going to bring real rates positive, and the velocity of rate increases that happens, like where liquidity is tightening, happens at a meaningful pace, that can drive more fear into those long duration, more speculative assets, because investors are going to say, well, why would I want to risk money on something that is continuing to underperform? I can take my tax loss, I can harvest it, and I can invest it in something that's a stronger late cycle play, or put it in cash, or maybe buy some of these 7% treasury bonds, whatever. There's a lot of other options out there. So I think the space, even though technically speaking, there's been a lot of sort of de-risking and lower prices, from sort of a market balancing standpoint, there's still more room to the downside if the fear is strong enough. And the problem is that a lot of this stuff isn't really in any indices, and it's not, a lot of them aren't in a lot of these funds either. So there's just not a lot of passive flows that are supporting the bit higher. So I think that's what makes it a little bit more vulnerable. But we have to keep an eye on, the Fed's tone, the sentiment of the market, the velocity of nominal and real rates increasing, and sort of what the prevailing order flow is. Which sectors are benefiting, right? Is it more of this long duration stuff, or are we getting back to the late cycle reflation idea?
Yeah, agreed with. Actually shared a tweet which I found really interesting. Is one is the market caps of the mega tech companies, but then one is another view of Apple versus the tech sector in general as a market cap as a whole, and how much of that is driven by Apple. So I think you're right. I think that it's insane how these mega techs have, and you're right on that stat. I think it's 1/3 of the gains this year were driven off these guys as well as Nvidia. So it's definitely been a big push from Megatech. And I think, yeah, the tonality is definitely very important. So, Akib, does that answer your question? I know this was pretty long-winded.
No, that's actually what I was looking for. So I do appreciate those uh long-winded responses because it's not an easy subject. So really appreciate you letting me ask that question, and definitely appreciate your guys' in-depth answer and analysis.
Yeah, for sure, man. Thanks for joining. Thanks for asking a question. If anyone else has a question, feel free to request. You can come up and speak and ask us, and we'll try to answer it best of our abilities. But Luca, I don't think you got to chime in there. Anything from you you'd like to add?
I mean, so it was all pretty much covered. But the question was, what could we see out of the Fed this week that would send the markets higher? And really, what we saw a few weeks ago in that hearing, where really a lot of this Fed action was triggered, was when you saw Chair Powell. He came out and he was more hawkish, or he seemed more hawkish than what was expected. And I think you could think of that, I think, as two steps forward to where the Fed wants to get. And I think if he goes one step back, and those, the fears right now aren't met with actual action or commentary or tone out of the Fed, you could see the market move to the upside. So, for instance, right now it seems the big fear, or at least the big question mark, is how much quicker does this taper get, and when do we get rate hikes? And if we don't get much action, much commentary on the rate hikes, and they don't get all too aggressive when it comes to speeding up that taper, I think you'll see the market possibly move to the upside, and see some high, some moves, some net positive moves. But if those fears are met, or if something occurs, you really don't know until you hear from them. If they speed the taper up a significant amount, or if we get action like that, I think you could also see downside. I look at the charts, I look at SPY, I look at QQQ, and I look at these charts, and they don't look fantastic to me. I look at QQQ today; it lost its 9 EMA, and it formed up a pretty not amazing candle. So I kind of look, at the markets right now, at least the broader names and indexes, and they don't look fantastic on a technical basis. So once again, I just think if you're longer term, you just sit back and focus on your long term plan. If you're a shorter term trader or you're taking swings, I think you just take a little off and you just wait and see what happens.
Nice. Thanks, Luca. Money talk. I see you requested to speak. What's going on?
Yeah, hi. So first, I want to say thank you guys for putting this together and being very helpful. And then my question is kind of based on, so personally, I still do believe that even though Jerome Powell's kind of flip-flopping on his inflation being transitory statements and etc., I still do believe it is transitory and it's going to kind of flatten itself out throughout the time. But however, let's say it's not, okay? But still, is there any way he can handle the inflation problem without actually raising the rates? Like, what are some other alternatives to?
I honestly don't think there's a. I think he's thought of that, right? I think that's the reason he's been pretty dovish the whole year. I think the fact that the Fed doesn't have much. I mean, if you look at Paul Volcker's, or I think I might have pronounced his name wrong, but it was the 1970s. Inflation ran hot, and they had to raise rates pretty substantially. This is one of the few toolkits it really has, right? And I think the fact that it stayed so dovish and it pumped so much money actually probably drove part of it.
Yeah.
You can, like it made it worse. So, first of all, you need to retract that, and then and also I think another part that I keep hearing that doesn't get talked about as much on FinTwit, but if you listen to the All In podcast, which is run by Chamath, David Sachs, Jason, and all them, they also talk about how the amount of stimulus that was pumped into people's hands has incentivized people to work, and that it causes problems with supply chain and having different challenges at ports and other parts of our economy, right? So there's a lot that needs to kind of get unwinded here, but at the same time there are multiple challenges, right? It's not just the rates, it's you have a global pandemic, you have supply chain issues, you have a global workforce that has, we've changed the way we work, right, the past 2 years. So there's a lot that needs to kind of happen. So honestly, and also to remember, right, just the actual pressure within Congress and like around Powell. I mean, a lot of people wanted him to go hawkish way earlier than this.
Yeah,
I don't know what really made him snap last month because he was pretty
he
much
got
the whole
reelected.
year.
He got
Yeah, I think.
reelected.
Yeah, no, that's definitely a part of it too. And I guess I can't say that definitively, but yeah, he did get reelected, and I think he had less to, I guess, on stake lose for himself, but. He really made people believe that he was going to stay dovish a little bit longer. So I think, yeah, you're right. He did get reelected, and he had the pressure, I think, politically, right, within the like different
Yep.
people within the Fed. So there's just so much. I mean, I would be shocked if he was to track like go complete opposite. I mean, or Luke, if you guys want to chime in, I see you guys other questions. We will get to everything. Don't worry, I see everything.
I think there are other tools that are available to curb some of the input mechanisms for some of the inflation we're experiencing. That would be matters of coordination between the government and the Fed. I mean, one thing they could do is reduce speculative limits in commodities and reduce who can take on those positions and how much leverage they can take. I think that could actually have a pretty helpful effect in certain areas. I mean, I know that if you go to the Permian Basin, there's a lot of places like Exxon's producing fields. They can produce oil like 20, $25 and still make good money. I'm not saying we need oil down there, but I'm saying there's a lot of speculative excess that gets built into crude when it gets above, say, 80, 90, 100, and we're not in a deficit environment. On the other side of it, I still think that if we have inflation in this economy, if we're just discounting for asset inflation, which typically doesn't introduce a ton of real world inflation, if we're looking at real world cost of living inflation, a lot of it's coming from some of the supply chain issues. And if the Fed's tightening and other central banks are tightening liquidity, and we're still having those disruptions and raising the cost of doing business for these companies, it could actually have the counterintuitive effect of increasing some of these inflationary pressures. So I think they have to walk a bit of a tightrope because, and I've said this a bit on Twitter, that I feel like cyclical inflation is going to be, and has repeatedly been, overpowered by secular deflation. We are still in the late stage of a very powerful debt super cycle. And we're talking, hundreds of trillions of dollars of rate-sensitive debt around the world. When central banks start normalizing rates and policy and kind of deliquefying the global credit markets, that inherent fragility begins to become more problematic with any significant event catalyst. And as this is all going on, we have plenty in the potential making between geopolitical risks, risks with China's real estate market unwinding, the potential for an actually more serious variant of COVID to emerge, and other sorts of strains that can emerge, in a tightening credit environment. So I think that the Fed will tighten. I don't think that their framework is going to deviate too much from that, but I do think there are other considerations to be made, and I don't think they're going to be able to normalize to anything that people would consider to be a sort of normalized rate environment, like 2-3%. That's probably the top end of their hiking cycle this time around. I think that it's very likely, given that the global economy is already starting to turn lower in terms of growth and liquidity is already starting to tighten around the world, that the next recession is probably not much more than a year away. So they've got to kind of shore up ammo, and I think that's what a lot of central banks are really doing in this tightening cycle too. It's not just the excess and the wall of liquidity in response to the COVID crash, but it's also that they see that this is really just the tail end of the cycle that started in 2009, and they need to prepare for the next sort of credit unwind, and part of that shoring up ammo as well.
Correct.
Your question, Manito.
Yeah, that answered my question, but I kind of have a secondary one, but I'm willing to wait because Clinton's in a little bit of a rush over here, so I'll let
Okay.
I'll let
You
my
can
boy
stay
take
on
it.
and we can follow
Yeah,
up with
for sure.
Clinton. What's going on, Clinton?
Hi, first of all, thank you on this space. I'm a writer with the Ottawa Hill Times and Troy Media in Canada. So, in regards to inflation, I guess one of my concerns or worries about this, and I'm someone who follows the markets closely like the rest of you folks, is that I'm not really sure that there is anything the central bank can really do right now. And I would argue that the sort of the earlier position taken by the central bank and other central banks around the world, including Canada, was the correct one. And that's that, how does a central bank deal with inflation that's not really being generated within the boundaries of the nation itself? So in other words, when the food basket in place serious drought and is unable to supply adequate food, we see inflation in food prices. I'm not sure what the central bank can do about the drought in Brazil. If we look at China, going to the beginning of September, Beijing had publicly gone on the record, for what it's worth, that they were toying with the idea of going into essentially another lockdown because they were not convinced that they had COVID under control. And so, in regards to the supply chain issues, I'm not going to get specific, but I'm also in the manufacturing business outside of writing. And so, when the world's manufacturing center, in this case, mainland China, is shutting down its manufacturing facilities, that's going to drive up inflation through the supply chain, which, much like Brazil, I don't think the US Federal Reserve, the Bank of Canada, the Bank of England, or any other bank has any real control over something. So I think we're in a unique set of circumstances, and I'm curious what some of the others, if the type of inflation we're seeing is one that our own respective national banks aren't really going to be able to deal with because there are issues outside of their control. Another example is, the more or less, I don't want to say closure, but I mean, for all intents and purposes, the Los Angeles port has kind of been a basket case for months now, and goods aren't getting in there. So I'm not sure how the central bank, either raising or lowering rates, has any real effect on getting the port of Los Angeles moving. So I'm just curious what your thoughts are on that.
Yeah, I think those are all really good points, Clinton, and it kind of hits home with some of the things that I was alluding to and then expounds on them in different areas as well, which is that, with supply chain driven inflation, the policy framework that they have at their disposal of raising rates and tightening liquidity by slowing down QE or even downsizing their balance sheet doesn't really do much but help to facilitate demand destruction, which is not enough to, fix some of these bottlenecks and even, create or facilitate acceleration of their resolution. And I think that, for the past, call it almost 40 years, let's call it like 35 years or so, disinflation has been introduced by having outsourcing to other countries where labor costs were cheaper, where there was a lower regard for the environment, et cetera, where there was also the potential to reduce cost by technological innovation. And I think that, for the former, globalization's probably run its course in a lot of that cost savings. But in the latter, there's still a lot of potential, I think, with innovation to ease some of these problems, but it's going to be in the intermediate to longer term. There's not a lot of short fixes that can really improve the situation, in my opinion.
Can I I just want to jump in and throw another point out there, and I'd like to hear your thoughts and anyone else's on this as well. I mean, I think one of the solutions might be diversifying trade, right? So, for example, we all know that China, whether we like it or not, is currently the manufacturing hub for the global economy. So maybe what the States and Canada and other nations need is some sort of a legitimate free trade agreement with a country like India, in order to encourage more manufacturing in India, to pull some of that away from mainland China, and to help sort of jumpstart some of those supply chains. I'm curious what your thoughts are on that.
So we've seen some of that driven by market forces primarily over the last several years, whereas costs in China were rising, so companies were going to different regions like Vietnam, Indonesia, Malaysia, India for some things, more services oriented parts of the economy. But that's something that I suspect would certainly continue. I mean, we have seen in some countries the supply chain issues were far less pronounced, and the government's response to COVID was let's shut down everything to try to stop the spread from a couple cases, whereas China seems like they're willing to shut down a whole port if there's a single case. So yeah, there's definitely some of that has been going on, and also for the reasons of intellectual property and some of the other things going on, I could see that continuing. And it could help for the global supply chain to have more diversification in manufacturing and other kinds of services. I agree. I think that's a good point.
Thank you.
No, thanks for sharing your thoughts, Clinton. And yeah, very valid concerns there around supply chain issues overall. I think it's going to be a big challenge. And yeah, Money Speaker, I see you. 1 second. Let's just go around, give her a shot real quick. Chris Patel, what's going on?
Hey guys, so I was wondering, we're moving pretty quickly into the electrified automotive space, not just on the consumer side, but now I think even with logistics. I think over the course of the next 10 years, I think a lot of people are underappreciating how fast we're going to be transitioning towards electrification. And how do you think that's going to impact inflation? Do you think most technology revolutions are pretty deflationary, but I wonder if this one would be any different, where a lot of the input costs that were traditionally done by big oil and big what do you call it, input costs are probably going to be reduced down, and then electrification will probably put more money in the pockets of the average consumers because there's less maintenance costs and the total cost of ownership will probably come down significantly. So I wonder how that'll affect it. Do you think it'll be higher inflation to come because of electrification, lower inflation because of technology and the disruptive nature of that, or do you think it'll just kind of be muted in that it'll cancel each other out?
I think that's a really good question. And part of the challenge with EVs is really going to be, where are we going to get the additional slack to provide the power for that much recharging? Because there hasn't been the requisite effort to build out the power grid. There's not an appetite for coal or natural gas, understandably, but there's also not an appetite for nuclear, and there's not enough solar and wind. So we have to ask, if we're taking our cars off of gas, which don't rely on the grid, and we're putting them on the grid to charge, and all around the same time, presumably at night, for a lot of these folks, where's that additional power going to come from? So if there's a lot of demand and there's not the elasticity, then in the short term it could be somewhat inflationary for energy costs that are providing energy to the from the grids providing it to these cars. So potentially pushing up the price of things like natural gas and coal, and increasing costs in other areas where that affects where those input costs can be a cost push inflation factor. Longer term, though, a lot of this innovation is disinflationary. Like you said, lower maintenance costs. I think longer term, when the technology is really perfected, you're going to have cars that can last 10, 15, 20 years with pretty minimal overhead. So I think the longer term time horizon is pretty good in terms of the net economic impact, and also getting rid of a lot of the pollution that builds into medical costs, which is a big problem for people and their quality of life in this country. So I think there's a lot of pros and cons, but the biggest thing we need in the here and now is a broader discussion about how we get from where we are in a very hydrocarbon-centric economy to one that has much more renewable energy sources that have the elasticity to support this kind of increased demand for the grid's power.
Can I just jump in there, because EVs is actually one of my specialties in my writings, and I agree with all of your points that you just made. I think the most obvious one that's not talked about, that really isn't pie in the sky, is that hydroelectric generation is by far the most green, renewable type of energy, but more importantly, it's consistent. So as many of us know here on this call, it's very difficult for business to operate if you don't have a consistent source of energy. And so hydroelectric power provides that consistency. And speaking as someone who's in Canada, I do know that the provinces of Manitoba, Quebec, British Columbia, and Newfoundland have tremendous hydroelectric resources, which, if the United States and Canada were to work together, could really build out that infrastructure and help make North America, for all intents and purposes, an electric car superpower. And in fact, in Halifax, Tesla has been working with Dalhousie University, and they've developed what's referred to as the Tesla Dalhousie University Battery Lab, where a lot of that fancy battery tech has been developed. And I do know that over the next 6 months, they're getting ready to unveil a new battery. It's actually called a dry cell, which range-wise will be good for about 530 miles of driving. So we are starting to see some of those huge advancements. And I do think hydroelectric power, as I said earlier, is a key component to beefing up North America. And the other side of that issue would be tidal power in the Bay of Fundy, where they have the world's highest tides. Some estimates show that the Bay of Fundy has the capability to supply electricity to the entire eastern seaboard in North America.
All right. Does that answer your question a little bit, Chris? I have shared a thread that I wrote on EVs in general, just on the future growth of it, the projections, where we are in terms of current versus future state. But yeah, I think these were definitely some helpful responses.
Yeah, thanks, man. Appreciate it.
Cool. Money. I think Shawnee G, you had a question. I don't know if you jumped off. You can definitely ask. I think I was going to ask you next. But in the meantime, money talk. If you want to go ahead, and anyone else has a question, feel free to request.
Yes. So my question was taking it back to the inflation talk. So where does crypto and Bitcoin play into this? Because it seems like that whole sector is just moving with the growth sector at this point, and it just doing what the growth sector does.
So I kind of look at crypto with through the lens of it being sort of light growth, in the sense that it's a high beta rate sensitive asset. It's more speculative, and so it's kind of at the whims of both sentiment and the abundance of liquidity. And we have kind of a downturn in both net. So I think that going into 2021, a lot of those rate sensitive high beta assets are probably going to be under increasing pressure and more volatile. That doesn't mean that Bitcoin can't have really big up days. It doesn't mean that it can't make another all-time high at some point, but it definitely, in my mind, looking at the correlations that it has, it tells me that it's not as much a hedge as it is really a sort of sentiment indicator for how bullish people are on just risk. And so if people are de-risking, I feel like risk assets across the board are going to be under increasing pressure.
Yeah, thank you. Yeah, I thought so too, because like it's become for me kind of like a fear index almost over the weekends, expecting what to expect on Monday for the growth sector. If it's doing very well on Sunday night, you already know the growth's gonna be green on Monday.
Yeah, exactly. It's a sentiment indicator. I agree.
Cool. Thanks for jumping in, Money Talk, and hopefully you got some answers there. Anyone else have any questions? In the meantime, definitely want to hear from Luke a little bit. He's been waiting to jump in on some of these topics, but if you have a question, just request to speak.
I would just mention, a lot of the questions have been obviously revolving around what the Fed is going to do, and what's going to come out of this meeting here. And I look at it actually a lot like I do any other event where the outcome is mostly unknown. For instance, an earnings report. Some people like to play earnings. I absolutely hate playing earnings because in most cases it's pretty much a coin toss. How are the numbers going to come out? And not only how are the numbers going to come out, but how's the market going to react to those numbers? And I think of this Fed meeting very much the same. What's the Fed going to do? That's kind of a coin toss. And how's the market going to react to what the Fed does? That's kind of a coin toss. So in both of those scenarios, what, in my opinion, you want to do is you just simply want to lower your risk. Now, I have put out several tweets along those lines, and people love to be like, oh, you sound like a bear. I'm far from a bear. A majority of my capital is still within the markets, but does not mean I'm not trimming or I have not trimmed. I trimmed a month ago. I trimmed out and I took some gains, and there's absolutely nothing wrong with that. But I just urge a little bit of patience. That's honestly all I urge, and that's what I'm doing in this scenario, and that's what I'd recommend to anyone who, as has been mentioned by several other speakers, if you're worried about your money in this market, with all of these things revolving the market currently, like this new Omicron variant and the potential actually for stronger variants, and then on the other side of that, what the Fed's going to do, if you're a bit worried, if you're you're not sure where things are going, which many people aren't, there's nothing wrong with taking risk off, and I absolutely hate it when people attack people for taking risk off the table. This is a game of capital protection and risk management, so there's no reason to be all in on this market right now, but that's just my opinion. I'd also mention, you take a look at EVs. It's a sector that I really like, and I think there's a lot of potential in that area. And there's not only potential like in the companies actually building out the EVs, but there's also potential. You can find companies that are focusing on building out the infrastructure for these EVs. So I'd also hint at looking there. And then finally, we were talking about crypto and crypto moving to the downside, and I think there's a mix of things here. First off, as mentioned by the other two speakers up here, Raul and Market Mayhem, it very much trades alongside growth, and that is because it's acted like it is, in my opinion, it's a risk-on asset. There's definitely no lack of risk in the crypto space, and I look at it and I see a lot of opportunity, but there's also a lot of risk on the flip side. So I am not surprised to be seeing that move down, and I'd also urge, take a look at the big picture. Take a look at, for instance, not only the overall equities market, not only the S&P 500 and NASDAQ. Look at the past 5 years. Look at the last 10 years. And look at the gains that have been achieved in the past 5 and 10 years. And take a look at the price action. And also look at the crypto world. I mean, think of how much Bitcoin itself has ran in the past 12 months. Think of how much Ethereum has moved to the upside in the past 12 months. So to be having a correction, be having downside action like we're seeing right now, I'd also somewhat argue, that's just the markets naturally correcting, and eventually they'll likely resume to the upside if these crypto markets continue to act more and more like the equities markets in general terms. So that's really what I look at. So on a long-term basis, for instance, I've held Apple for years. I'm not doing much with Apple. I'm just sitting on Apple, and the gains have been tremendous over the past 5 years. I am doing the same thing with a lot of other names, very similar to Apple in those names. There's no reason to be absolutely just selling the hell out of your long-term names if you have a 5 to 10 to 15-year game plan on those. But the shorter-term stuff, like the swing trades and stuff, there's absolutely nothing wrong with taking the profit you have on those or trimming back the unrealized gains and just waiting and letting the market do what it does. But that's really, those are my general thoughts on everything going on. A lot of people, they focus on the day and they don't focus on the big picture. And I'd also urge people to just zoom out, look at the big picture, look at what the markets have done time and time again. And history doesn't repeat itself exactly, but it tends to mimic itself in some ways. So that's kind of how I'm focusing on the markets.
Awesome. Thanks for sharing that, Luca. I think going off of that, I think it's to each their own in terms of style. I certainly agree in terms of zooming out, long-term investing. That's kind of my style as well. But I do think there's obviously going to be people that are in and out daily, probably listening in here, who I do want to kind of talk to in terms of what are you seeing in terms of just before the Fed tomorrow, just from a flows macro perspective, charts, just kind of a quick summary there. What's kind of some of the, I guess, actions you've seen in terms of pre-Fed meeting Wednesday, because the meeting starts tomorrow actually, but we get the rate announcement, or I guess the final comments, I think Wednesday at 2 p.m.
Yeah, we got the comments Wednesday at 2, and we have the press conference at 2:30, and typically we get some ideas. The real reaction is to the Fed the day after. Usually it's not even the same day. So some of the things that I'm seeing are de-risking and hedging flows, especially late today. Last half hour of trade, there was a lot of what looked like people either taking directional bets or hedging or trying to reduce value at risk by a lot of put buying on the S&P, the Qs, and a little bit on the IWM as well. And then there was also that close to, or perhaps even over 3. Let me take a look here at my news feed. I think it was about a $3.2 billion market on closed imbalance to the sell side. So it seems like risk off is a little bit of the name of the game today, especially into that close. We don't have the same kind of passive flows bidding up indices into the close as we're closer to OPEX, and those flows are happening earlier in the day as well. Volatility started to catch a bid really in the last 20 minutes of the day. So we are starting to see more evidence through that as well, that there looks like the puts are, at least in part, some hedging flows. So I think that people are getting ready for Fed Day by trying to control their risk, which makes a lot of sense. It's like Luke said, there's no reason to have to be fully risk on and max long ahead of a day where there's a lot of uncertainty. So we're seeing that at an institutional level, that some are paring that back. We have other event volatility drivers this week too. Outside of the Fed, we have PPI and core PPI tomorrow. And I think that's something that's important to keep an eye on, because that's really going to give us a sense as to whether the velocity of inflation is starting to slow at the supplier level. So that's going to be, I think, a sentiment impact. I would watch the reaction in rates and rate-sensitive assets after that data comes out. And then, of course, we have retail sales on Wednesday before the Fed, and so that's another one that I think is pretty important to watch, especially since we're going to see some of those holiday retail sales, and if they're pretty strong, or if we're starting to see them weaken a bit. And I believe that we're starting to see, peak U.S. consumer this quarter, and particularly this month, for a multitude of reasons, not the least of which is the pretty leverage. So, I think this week is going to be one where we got to watch key levels. We got to be aware that it's quad witching, so there's going to be greater price volatility. And if there's strong upside tape, I think there's going to be trade opportunities on some of the names where you see unusual options flows. They're getting bid up, or some of these short squeeze names. On the downside, I think that the rate sensitive stuff is still going to be among the weaker. If we have a weak day, some of the ARC names and names in that space are probably going to get sold off pretty hard, unless there's another exogenous sector-specific catalyst like oil going down 5% and dragging energy down with it. So that's kind of the dichotomy we're looking at. And then at the index level, everything's still in a pretty strong uptrend outside of the Russell. The Dow's made a great recovery. I think I remarked on Twitter is up about 2,000 points from its lows. The S&P and the Nasdaq are still looking pretty strong, even with their give back today. Although technically short term they could certainly give more back, but as long as we stay above say 4620, I think it's still pretty constructive on the S&P cash. And overall, I think we're going to get some some de-hedging after the Fed if it's not too aggressive. If the Fed's not too hawkish in their view and in their policy, then we might get a little bit of a bid after that, just as people take off some of those hedges. But we really got to watch this econometric data. We got to watch the Fed, and we don't want to try to outsmart the market. Let the market guide you. Don't fight the trend. Right now we're in an uptrend on a long term, but short term things are still pretty choppy. So unless you're a really sophisticated trader, it's a good time to be careful. If you're an investor adding on positions into weakness, be aware that cheap can always get cheaper, so it's easier to just wait for a reversal and follow the trend.
Well said, Evan. Well said. I see we have KT finally joined the call. KT, definitely feel free to chime in on anything you're seeing in terms of the flows, markets in general right now in the next day or so from a trading perspective, because I know that's what you're really doing. I see we have Jay Special Situations on as well. I'd love to have you on, send you a speaker invite, so feel free to jump on the panel if you'd like. But KT, go ahead.
Yeah, so like we discussed yesterday on our Sunday call too, right? Like on Spaces, we did see pretty much these lagging sectors, which are consumer staples and utilities, being leading last week, and the tech was kind of lagging, right? Like except for Apple and Microsoft. Other than those two, we had Amazon, Netflix, Facebook. All of these were lagging, and that was where we were like trying to talk about where this environment is going to be a complete risk off type of environment. Today also, again, we tried to break above that nice zone of 4700 on SPX, but we didn't, the bulls couldn't quite capitalize on it, and we had a pretty nasty rejection at the end of the day. Luca called Walmart out yesterday too. Like that was one of our biggest plays today. We had 100% gains on that. But other than that, we were like we had no clue what was going on, and as in like. Understanding what was going on, like it's quad witching too, right? Like you will see some massive swings out there in the upside or the downside, and it will be and when you get that strength and direction going into it, you can make a lot of money on the weeklies options too. For now, I don't think there is much of there isn't much of opportunity at the moment, but there are a few put flows that are there, but most of them I think are for hedging. I did see some IWM flows too for Jan next year, most probably because AMC is getting hit pretty hard, and they are betting on that going even lower, and AMC is one of the biggest like IWM biggest holders is AMC, so maybe they are hedging for that. For AMC also. But other than that, I think it all depends. I definitely feel it all depends on the Fed and how hawkish they are going to be. If Powell is going to have the same tune, I think we will. I think there's quite a bit of downside on SPX because Raul, I think we talked about one of that chart where like Nasdaq is almost at the all-time highs, and how the number of stocks that are like at down about 30% too, right? Like that's not a good sign at all for the market. So let's see if these internals also kind of improve over time for the next couple of days, and see what Powell says, and we just have to be patient for now, and go with it.
I think that's probably the best thing, right? Just being patient. Don't force a move here. We've seen an incredible run the past 2 years or year and a half. Definitely spoil the market a little bit, but managing risk, understanding sentiment, momentum, and the macro. There's no point of fighting the Fed or fighting the trend, right? I mean, what's the point of playing hero ball? It's your money. Try to preserve it, right? So we do have Jay, who's an incredible macro kind of analyst, I would say, in terms of just the way he understands it and just does a great job of breaking it down. So I'm going to hand it to him in a second. Anyone has a question, please request to speak. We're happy to take it. We have a great panel here with myself, Jay, KT, and Lou, as well as pounding the table hosting this. So go ahead, Jay.
Hey, thanks for having me. I just want to say that I'm absolutely not a macro expert. I think there are very few macro experts, and the ones who think they are macro experts are usually wrong. no one has a crystal ball. All you can do is read the data, interpret the data, be flexible, and change with the data. And since the first quarter of the year, we have been commenting about the divergence between the ARC type stocks and the rest of the market. And, all that has happened is a correction in those names that saw heavy individual investor flows. And in fact, many of these names were gamma squeezes. So if you think about Tesla, for example, just from a technical perspective, right, less than 2% of the market, but 85% of the retail options activity since Schwab made options trading free in 2019 has been in Tesla. There's a graph, I can repost the graph, but SocGen posted it. It's a pretty reputable source, and it is what it is. So we're seeing, a number the options activities at all-time highs. You have a number of accounts, individuals that simply, have been buying growth stocks on margin, and these are great companies, companies like SC, right, that, have traded down a lot. That doesn't mean they're not good companies. All it means is that some of these names are up 200-300% over the last couple years. And, everyone's thinking about valuation in a vacuum. Right, when you think about relative valuation, I'll just provide an example with DraftKings, right? DraftKings valuation is down 50%. So people are saying, well, all the other sports betting names are cheap. Well, yeah, they might have been cheap on a relative value basis 3 to 6 months ago, but you can't just freeze your analysis from 6 months ago and assume it's true and assume it's the same and bang the table, right? If the entire peer group is down 50%, then your relative valuation will say it is down 50% as well. We're also seeing this, this kind of death cycle in the ARC names because it is very apparent to me that hedge funds are shorting it. And what's happening is that today, there are more people who are down on average in ARC than there are people who are up on a money weighted average. So if you get more fund outflows followed by more short selling, you have this cycle, right? And people, even though the short interest is high, you need something to break that cycle. Right, and that cycle, that might be as simple as the Fed on December 15th, not being as hawkish as now the market thinks, and that could result in a face-ripping rally, Santa Claus rally. Right, that's one scenario. Another scenario is that these names continue to weaken, and there's room. If you look at their valuations, you look at their runs, you look at their earnings growth. They might screen a lot cheaper than they did 6 months ago, but there's room for them to correct even further into QT. Right? Tapering doesn't mean that much. All it means is it gives you a forward indicator on when quantitative tightening will happen. So if quantitative easing, slows down and tapering accelerates from 15 billion to 30 billion, it means that by March, that powerful, the most powerful person on the planet, Powell, right, adding liquidity to the market is going to be gone. He's going to reverse from QE to QT while, raising rates sometime in the first half of the year potentially. And that can force institutional investors to right-size risk, right? And the marginal investor, before retail got, involved majorly in late 2019, was the hedge funds. And, as hedge funds de-risk, de-leverage, position hedges, they're the marginal force in the market. And they're the ones that, even if big institutional mutual funds and, pensions and insurance companies aren't selling, right? It's the hedge funds that essentially guide the short-term movements. Now, some of these companies could be wonderful companies over 2, 3, 4, 5 years. I'm personally looking to buy some of these companies that have sold off 30, 40, 50, 60%. SaaS companies that were trading at 20 times, they're now trading at 10 times. And you know what? They could also trade down to 5 to 7 times. There'd be wonderful buys there too. So just keep in mind, as the data changes, don't be wed to anything. Long-term investing is very important. You could have bought, for example, Apple in 2004 at 5 times EBITDA. That doesn't mean that Apple today is glaringly cheap. It has a fortress balance sheet. It's a great company, right? But buying call options and gamma squeezing it like you saw on Friday wasn't the smartest move in the world. So it's a very tricky market because there's so much options activity and there's so many names that move, and you don't understand why they're moving. Did the company report good news? Is there, potential sale? Is there a spinoff? Is there a change in the industry? Are they seeing uplift because of a new product line? No. So in many of these cases, things have rallied simply because they've rallied, because of flows. And that's something important to consider. It's important to have some cash, and, it's also important to have conviction in some of the core positions you have. And I don't want to drone on, but, there's a lot of data coming up. I know that we talked about PPI. There's so much that we don't understand about how this cycle is going to play out, what inning we're in, how the supply chain is. Inflation could have peaked already, but there's some uncertainty as to how Omicron's going to play out, how supply chain is going to play out. There's concern. There's always going to be that type of uncertainty. But I think at this point, when you have everybody so long on the individual investor side, that capital isn't sticky. So you get a little bit of fear, and you look at names like AMC, like you completely unravel, right? Like there's nothing holding them up because when an individual investor is down 20, 30, 40, 50%, right? They don't have a mandate to stick to their core positions for 5 years, like a mutual fund or a pension or a long only. So it's just something to think about. But I'll stop speaking and come back if anyone has any other questions.
No, thank you. Thanks a lot, Jay. Really appreciate that, and I think this was definitely some great input from Jay. So, with that, I guess I think we have a question from Ariel. So, if you wanna go ahead.
Hello, guys. Good afternoon. I just have one question. As you guys know, I'm pretty sure the Senate is voting on whether or not to raise the debt ceiling, and I don't know. I looked it up.
I think they already did that last week, right?
The House did it. The Senate is voting on it.
Oh, the House did it. Right.
I think Schumer reached an agreement on the Senate as well.
Really? I don't know. I just saw a tweet.
The vote might still have to happen.
Yeah, there's an agreement.
Yeah, I thought it was agreed, but I didn't know about the vote. Yeah, that's what I thought. Yeah,
I believe
they probably already unanimously agreed on it before they even voted on it. But even in the case that, like, let's just say
anyone know
hypothetically they
definitively?
don't pass
Luca,
it.
go ahead.
Let's just say, like, hypothetically, right? They didn't pass, like, they didn't raise the debt ceiling. That's never happened before. Like, according to them, if we didn't raise the debt ceiling, we would default on what we owe, and that's never happened before in history. So let's say hypothetically, if the Senate were to say no, we're not raising the debt ceiling, we can't spend any more money. What do you guys think would happen, since it's never happened before?
It would be temporary volatility. So I don't know if you remember 2011. There's a similar scenario where one of the rating agencies was actually bold enough to potentially, to think about downgrading the U.S. credit rating. In reality, if something like that were to happen, there'd be so much money flowing to treasuries, it would effectively lower the entire rate curve, right? So, I mean, the U.S. Treasury is a flight to safety. The asset that the U.S. has is the most amazing asset on the planet. It has the net present value of the tax payments of the best companies in the world. Think about that. In perpetuity, they're going to be collecting taxes and senior to the capital structure where you are as a common equity holder in perpetuity. And that asset is worth a tremendous amount. And, the U.S. consumers are in great shape as well. So the ability for the U.S. government to tax its people and its companies is probably the best that we've ever seen. And we inherently fundamentally have the ability to service our debt. So it might result in some, I don't think it'll happen, but it might result in some temporary volatility, but that potentially, in my opinion, would be a buying opportunity.
So you don't see it, like, you think they're just going to keep kicking down the can like this? That's just no.
Oh yeah,
no
they're going to continue to kick down the can, and in 20 years,
that bill is not passing tomorrow. Is what you're saying? Like, there's you don't see it any other way. Like, that is passing. They are going to raise the debt ceiling.
I think every 5 to 10 years. I think every 5 to 10 years, when we have a recession, there's going to be more debt in our country,
and there's going to keep.
The Federal Reserve's going to be bigger.
Not going to stop. That's insane.
They're going to monetize it at some point, right? That's what. Think about it. 80% of the interest payments, not 80, but a little bit less than that, is going back into the Treasury. Think about it. I mean, not 80, but if the Fed is 8.6, over 8 trillion. Sorry, that was a misprint. If the Fed is owns 8.6 trillion of Treasuries, where is all the interest going? It's going back to us, right? So in a weird way, we're just paying ourselves. And if the Fed just continues to grow its balance sheet, the Treasury is going to be benefiting from a large percentage of those interest payments.
No, I get what you're saying. No, I mean, I'm only 20, and I know that talks of raising the debt ceiling, it's been happening for years, what I mean? But like I said, I'm only 20, and I've only recently just started getting into the market now, so I only read up about this news now. But for someone who's been in the market for a while, 40, 50, they're 40, 50, they've been trading for 20, 30 years, they probably heard this debt ceiling talk like 10 times already, what I mean? So for people who have already been trading, I mean, is this any different? Is this just more
pretty much
fear-mongering?
It's just pretty much fear.
Yeah.
Yeah.
Wow, that's insane.
Yeah, no, I wouldn't look too much into it unless obviously something was to change and it didn't pass, or you
Because
get,
they make it seem
I guess,
catastrophic. They seem
conflicting.
that if
See,
that bill were
it's
to be
only
Yeah,
going to
passed,
hurt
it
everyone
is.
would go into
Congress.
depression.
It's
Like,
only gonna
So,
hurt it's gonna hurt, like Jay said, it's gonna hurt Congress the most. It's never happened in history. If that happened in anyone's kind of political presidency, it hurts them the most. So I agree with. First of all, I mean, commend you for doing this at age 20. I was not doing this when I was 20 years old. So the fact that you're reading into this type of stuff and have started at this age is it's amazing. But in terms of, I guess, the fear you might have, or I guess the fear media might put out there if this was not to go through, first, I don't think that's happening. I think it is going through. They already have spoken about this. And second, you're right. Yeah, if it didn't go through, like Jay said, it affects them the most. So yeah, it certainly will cause volatility. It's definitely not a good thing to happen. It's had history. It's never happened. But it is something to keep in mind, right? I think the debt we're taking on, it's pretty insane. I think you touched on this, MM.
it's
But
insane.
this is like, I guess, futuristically, like, this is definitely not, like, this is another big catalyst that can come to bite us down the line.
Oh yeah,
Like
I mean,
everything in the moment, like inflation, the like everything is just really bad in this present moment.
well, but it's. I mean,
Yeah,
that's just
yeah,
because
yeah.
it's the present moment too. I mean, we've certainly been through worse as a country and survived and thrived. I mean, I don't think that this moment is going to be what defines this decade. It's a challenge. We've got a lot of stuff we've got to work through, but ultimately, this debt ceiling stuff is just theater. And
Theater, right?
and
I
yeah,
agree with that.
and they're really just they're really just scaring up some headlines and dramatizing it and yelling saying what would happen if they did it. But we all know they're not going to do it. I mean, unless the divide in this country gets much worse, and you have parties that are just set on actually destroying the country, and that's what their goal is when they're in office. I don't see any situation where they don't at least like do a 2 week to 6 week extension and keep kicking the can short term until they find a longer term resolution. But this has been it's been all about optics. The Republicans are trying to pretend they're fiscal conservatives. We know that neither party is fiscally conservative at all, but that's sort of the narrative that's being created, and that's why it was being done to kind of placate the voters. So we're going to get it behind us. We're going to look forward, and there's going to be actual potential negative event catalysts to navigate our way through. But this is kind of a non-event.
there was so much shaming in 2011. If you think about it, if all the postal workers all of a sudden weren't getting paid, if the IRS workers weren't getting paid, right? The congressmen and women would be getting calls, unbelievably nasty calls, right, on a daily basis. It's just not in their best interest if they want to
And
get voted
some
in.
of these unions, yeah, and some of these unions are some of the people that are backing the different. So it would be. I would be shocked to see it in a lifetime. To be honest, at least not anytime soon. Maybe in a lifetime, but I don't think anytime soon. But yeah, with that, Ariel, does that answer your question?
Yeah, I want to say thank you for all you guys for all your opinions and stuff. Thank you guys.
You're welcome.
Sure.
You're welcome, and thanks for joining. Anatoly, I'm sorry if I pronounced your name wrong. I think you had a question.
Hey, yeah, what's up? Thank you very much for giving me this opportunity to get on here and ask you guys questions. I've only been in the market, for a year or so. I'm only 22 years old. And with the Fed coming up and talking about tapering and everything, do you guys personally think it would be better for Jerome Powell to be more hawkish, or otherwise, how would you like to see him, and what would you like him to say on Wednesday's meeting,
So that was
for long-term
probably the first
investment?
question. Yeah, that was the first question I think we got when we opened up the spaces. I think we can reiterate there, and I'll pass off to MMJ as well. But I think the first thing you want to see is clarity. What happened a couple weeks ago was it caught off the market off guard when you went a lot more hawkish than anyone would have expected. The market likes clarity, right? So that's number one. Number two, to come in line with what projections are. So that's, I think, 15 to 20 billion taper, as well as 2 to 3 rate hikes are potentially expected. A timeline on how these things are going to work. And nothing to kind of set alarms off or add, I guess, more volatility or something the market can't expect, right? The market is playing off data, right? So it's the data that you get is the data you can kind of make decisions off of. So if he does something that no one expects or doesn't have data on, then it's going to certainly catch people off guard. But that's just kind of very high level. We touched on this pretty in depth, but I guess since it's brought up again, we can definitely kind of answer this again. MM, if you want to take it, and then Jay.
Sure. Yeah, I agree with everything you're saying, Rahul. I think the Fed is kind of doing a balancing act with expectations. And remember, this is a Fed that repeatedly said that they were going to be very careful to communicate clearly what their policy framework would be in advance of implementing it. That was sort of the whole idea of this renewal of QE, to try to avoid the mistakes that had come previously and created those taper tantrums when the market was suddenly caught off guard. Now, I wouldn't necessarily call what we're caught in a taper tantrum, at least not yet, but it certainly did create a bit of a risk-off environment. It caught a lot of people off guard, as Rahul said. So the market, it really does want to see the Fed, kind of give clarity as to what their expectations are. What is this tightening cycle going to look like? Are they going to still be amiable towards changes in the data, changing their outlook policy, or is this going to be a fixed policy? Because going into the December meeting, taper was variable. They said they were going to revisit it. Now it sounds like not only is it more certain, but they're going to accelerate it. So what are they going to do moving forward? Are they going to leave the door open to keep it the same, to accelerate it, to put their feet on the brakes? Those are things that remain open-ended questions. And then, of course, the dot plot, is it going to suggest that there's a more aggressive rate hiking cycle? I think it probably will. Like Rahul said, 2 to 3 is the expectation. I think much more than that, and much more than $15 to $20 billion a month acceleration of existing taper could accelerate risk off, and especially be detrimental to more rate-sensitive assets. So, we got to kind of watch not only the reaction to the Fed after, they release their...
and, in 20 years...
That bill is not passing tomorrow, is what you're saying. Like, there's, you don't see it any other way? Like, that is passing? They are going to raise the debt ceiling?
I think every 5 to 10 years... I think every 5 to 10 years, when we have a recession, there's going to be more debt in our country,
and there's going to keep
the Federal Reserve's going to be bigger.
Not going to stop. That's insane.
They're going to monetize it at some point, right? That's what. Think about it. 80% of the interest payments, not 80, but a little bit less than that, is going back into the Treasury. Think about it. I mean, not 80, but if the Fed is 8.6, over 8 trillion. Sorry, that was a misprint. If the Fed is owns 8.6 trillion of Treasuries, where is all the interest going? It's going back to us, right? So in a weird way, we're just paying ourselves. And if the Fed just continues to grow its balance sheet, the Treasury is going to be benefiting from a large percentage of those interest payments.
No, I get what you're saying. No, I mean, I'm only 20, and I know that talks of raising the debt ceiling, it's been happening for years, But like I said, I'm only 20, and I've only recently just started getting into the market now, so I only read up about this news now. But for someone who's been in the market for a while, 40, 50, they're 40, 50, they've been trading for 20, 30 years, they probably heard this debt ceiling talk like 10 times already, So yeah. For people who have already been trading, is this any different? Is this just more
pretty much fear-mongering? It's just pretty much theater.
Yeah.
Wow, that's insane.
Yeah, no, I wouldn't look too much into it unless obviously something was to change and it didn't pass, or
because they make it seem catastrophic. They seem that
it's only going to hurt Congress.
Go into depression.
It's only going to hurt. It's going to hurt, like Jay said, it's going to hurt Congress the most. It's never happened in history. If that happened in anyone's kind of political presidency, it hurts them the most. So I agree with. First of all, I mean, commend you for doing this at age 20. I was not doing this when I was 20 years old. So the fact that you're reading into this type of stuff and have started at this age it's amazing. But in terms of, I guess, the fear you might have, or I guess the fear media might put out there if this was not to go through, first, I don't think that's happening. I think it is going through. They already have spoken about this. And second, you're right. Yeah, if it didn't go through, like Jay said, it affects them the most. So yeah, it certainly will cause a volatility. It's definitely not a good thing to happen. It's had history. It's never happened. But it is something to keep in mind, right? I think the debt we're taking on, it's pretty insane. I think you touched on this, MM. But this is like, I guess futuristically, like this is definitely not like this is another big catalyst that can come to bite us down the line.
Oh yeah,
like everything in the moment, like inflation, everything is just really bad in this present moment.
Well, but it's. I mean, that's just because it's the present moment too. I mean, we've certainly been through worse as a country and survived and thrived. I mean, I don't think that this moment is going to be what defines this decade. It's a challenge. We've got a lot of stuff we've got to work through, but ultimately, this debt ceiling stuff is just theater. And they're really just scaring up some headlines and dramatizing it, and Yellen's saying what would happen if they did it, but we all know they're not going to do it. I mean, unless the divide in this country gets much worse, and you have parties that are just set on actually destroying the country, and that's what their goal is when they're in office. I don't see any situation where they don't at least do a 2 2-week to 6-week extension and keep kicking the can short term until they find a longer term resolution. But this has been it's been all about optics. The Republicans are trying to pretend they're fiscal conservatives. You know, we know that neither party is fiscally conservative at all, but that's sort of the narrative that's being created, and that's why it was being done, to kind of placate the voters. So we're going to get it behind us. We're going to look forward, and there's going to be, you know, actual potential negative event catalysts to navigate our way through. But this is kind of a non-event.
There was so much shaming in 2011. If you think about it, if all the postal workers all of a sudden weren't getting paid, if the IRS workers weren't getting paid, right, the congressmen and women would be getting calls, you know, unbelievably nasty calls, right, on a daily basis. It's just not in their best interest if they want to get voted in.
Some of these unions, yeah, and some of these unions are some of the people that are backing the different. So it would be. I would be shocked to see it in our lifetime, to be honest. At least 90 times soon, maybe in our lifetime, but I don't think anytime soon. Yeah, with that, Ariel, does that answer your question?
Yeah, I want to say thank you for all you guys, for all your opinions and stuff. Thank you guys.
You're welcome.
Sure. You're welcome, and thanks for joining. Anatoly, I'm sorry if I pronounced your name wrong. I think you had a question.
Hey, what's up? Thank you very much for giving me this opportunity to get on here and ask you guys questions. I've only been in the market, you know, for a year or so. I'm only 22 years old. And with the Fed coming up and talking about tapering and everything, do you guys personally think it would be better for Jerome Powell to be more hawkish, or otherwise, you know, how would you like to see him, and what would you like him to say on Wednesday's meeting for
probably
long-term
the first
investment?
question. Yeah, that was the first question I think we got when we opened up the spaces. I think we can reiterate there, and I'll pass off to MMJ as well. But I think the first thing you want to see is clarity. What happened a couple weeks ago was it caught the market off guard when you went a lot more hawkish than anyone would have expected. The market likes clarity, right? So that's number one. Number two, to come in line with what projections are. So that's, I think, 15 to 20 billion taper, as well as 2 to 3 rate hikes are potentially expected. A timeline on, you know, how these things are going to work. And nothing to kind of set alarms off or add, I guess, more volatility or something the market can't expect, right? The market is playing off data, right? So it's the data that you get is the data you can kind of make decisions off of. So if he does something that no one expects or doesn't have data on, then it's going to certainly catch people off guard. But that's just kind of very high level. We touched on this pretty in depth, but I guess since it's brought up again, we can definitely kind of answer this again. MM, if you want to take it, and then Jay.
Sure. Yeah, I agree with everything you're saying, Rahul. I think the Fed is kind of doing a balancing act with expectations. And remember, this is a Fed that repeatedly said that they were going to be very careful to communicate clearly what their policy framework would be in advance of implementing it. That was sort of the whole idea of this renewal of QE, to try to avoid the mistakes that had come previously and created those taper tantrums when the market was suddenly caught off guard. Now, I wouldn't necessarily call what we're caught in a taper tantrum, at least not yet, but it certainly did create a bit of a risk-off environment. It caught a lot of people off guard, as Rahul said. So the market, it really does want to see the Fed, kind of give clarity as to what their expectations are. What is this tightening cycle going to look like? Are they going to still be amiable towards changes in the data, changing their outlook policy, or is this going to be a fixed policy? Because going into the December meeting, taper was variable. They said they were going to revisit it. Now it sounds like not only is it more certain, but they're going to accelerate it. So what are they going to do moving forward? Are they going to leave the door open to keep it the same, to accelerate it, to put their feet on the brakes? Those are things that remain open into questions. And then, of course, the dot plot, is it going to suggest that there's a more aggressive rate hiking cycle? I think it probably will. Like Rahul said, 2 to 3 is the expectation. I think much more than that, and much more than the $15 to $20 billion a month acceleration of existing taper could accelerate risk off, and especially be detrimental in more rate sensitive assets. So, we got to kind of watch not only the reaction to the Fed after, they release their policy and Jay Powell has his press conference, but really also the reaction in the next day or two. Because it can take a little while for the market to digest everything and really give you the idea of where price action is going. But in an environment like this, it's probably good for people that are feeling a little leery about volatility. Consider taking a little risk off. If you're more advanced, you can always consider putting on some hedges if you know what you're doing. But, this could be a choppy week with the Fed and then with quad witching on Friday as well.
And not only that,
Yeah,
I mean,
and
think
I don't
about
know
where
what
we are.
happens. Go ahead, Jay. Go ahead.
I mean, think about where we are from, where we are in the time of the year, right? There's a lot of tax loss selling. From a hedge fund perspective, most of these guys get paid their bonuses in January, right? So these guys for the last couple of weeks have been closing positions and deleveraging so that they can get paid, right? Like I have a friend at a fund who, they make 2 and 20. It's 2% of the base fee. It's actually 1.5 now for this fund, and 20% of the profit. So he's gone from making, in his mind, 3 million, right? And now he's going to make 2 million because he's given up a third of his returns just in the last month. So, I mean, he doesn't want, to lose another 5-10% of his P&L going through the end of the year. So, I mean, that's how some of these guys are thinking. It might be a good long-term buying opportunity soon. I mean, no one has a crystal ball. It depends on whether Powell accelerates from here or not. So I think the important thing is to be very flexible, to keep your eyes on the market over the next, 2 or 3 days. There could be an opportunity to deploy. There could be an opportunity to, if we do rally, to reallocate into certain things. I think like defensives, financials could perform well next year. Some industrials, maybe even energy into driving season. It really depends what happens with Omicron in emerging markets because they're the biggest consumers of commodities. But when it comes to this coming week, it is probably one of the most important weeks that we've seen this year because right after that we have a holiday week. So things might get illiquid and moves might be exaggerated. And, there's been a lot of pain felt, and it's not apparent from what we're seeing in the broad indices, right? And the Fed has a dual mandate: price stability and unemployment. Unemployment's at 4.2 optically, right, regardless of what's happening with the labor force. And optically, inflation is at 6.8, whether it's peaked or not. And they use PCE, but CPI is a proxy. So when you're thinking about that, there's a third mandate that everyone knows about, which is asset prices. And real estate prices are near all-time highs. The broad indices are at all-time highs, right? We're up 5x in 5 years, right, for broad indices. So, there's still a Fed put, but the Fed put is not like if indices are down 5-10%, Powell's going to come running. That's no longer the case. And I think that is a big difference from the last few years when mutual funds and hedge funds could always assume that buying the dip would be rewarded. And this might be the first time in many years where it's not rewarded immediately. So it's just something to think about.
So I have a question.
Awesome. Thanks for sharing that, Jay. Hold on. Please, we have a few questions ahead. If you're going to come up and speak, please either raise your hand or just wait till I call on you, please. Anatola, does that answer your question?
Yeah, thank you. I would just like to reiterate my point. Just a quick question. Would you like to see if the Fed sticking to their guns and commit to tapering and raising rates on whatever the timeline is, or they decide on, or no matter the COVID-19 environment, or would you think it's better if the Fed adjust to the rate hikes as the COVID environment changes as well?
I personally prefer them making a decision on this sooner than later and giving us a definitive answer. I'm kind of tired of this whole when are they going to do it. I think everyone's accepted that it's going to happen. It's just a matter of when and how much it happens. But Jay, go ahead.
I'm in agreement. I think that we've been in this limbo. I'd rather just rip the Band-Aid off and be able to value companies again without worrying about what the Fed is going to say. So I think that, we still have another couple weeks to see it, but hospitalizations and ICU admittance and deaths haven't been as bad. I still think we might get some Omicron, ramping up, especially after the holidays in the Northeast. We might see some alarming numbers. But I think people are tired of being, locked down, and I don't think we're going to be in a state of lockdown in the U.S. apart from maybe a couple cities and a couple states. So my view is that we just ripped the Band-Aid off. It's been 2 years, and go back to being able to pick stocks again without worrying about the Fed.
Amazing. Thank you very much, guys, for letting me come on here and ask you guys questions. Thank you.
Absolutely. Thanks for joining in. Please stop by again. Before I kind of go to some more questions, I know I'm getting a few pings when we're going to do these, and it seems like because we did one yesterday morning, we have one right now. Our next one is planned for Wednesday, 6 p.m. It's already shared, pinned above, as well as we have another one I'm going to be doing next Tuesday. I have not shared the details of that yet, but it will be announced soon. It's going to be with Sawyer Merritt around Tesla, and we may do these casually pretty much daily. So as I mentioned earlier, if you want to kind of stay in touch in terms of when these are happening, best way will be to just give the panelists a follow. You'll see us speaking and get notifications on when we share these spaces links. So once again, thanks to Jay coming on, Problem Snipers, KT, Luca, and Pounding the Table for hosting this. So give the panelists a follow. We've been going for an hour plus strong, and we'll keep going. I think we have a lot more questions. So Jeremy Lin, I don't know if you're actually Jeremy Lin, but he's one of my favorite players on the Knicks. So it's an awesome handle. What's going on?
Hey, appreciate you guys hosting this. I had a question for Jay, actually. I wanted to get his take on the recent price action in the 10-year. I know you've been a big advocate of the potential situation of Powell being a little too late to the game, and inflation potentially peaking right now. So if he were to get some, political pressure from the Republican side, based upon expediting the taper, and maybe a few rate hikes next year, do you think the 10-year yield is potentially pricing in this slowed economic activity right now?
Yes.
Okay.
I think that, we're kind of pricing in 23, 24, seeing rate cuts again. And this happens every time. This happened in the last couple of tapers when, it becomes apparent that the Fed is going to act hawkish. The front end of the curve rallies and the back end of the curve comes down, flattening the yield curve. And, it's an indicator that the economy will slow down. The economy is going to slow down anyway because we're not going to see the stimulus that we saw this year or next year. We had 5.6 trillion of fiscal stimulus. We had fiscal stimulus all over the world. We're not going to see, mid to high single digit GDP growth next year. So, or the year after, right? So the market is forward looking. I think both inflation and GDP will come down next year. And if, asset prices start coming down, in a way that is a surprise, then you could see, the economy slow down more than expected. And I think that is what the yield curve is showing, but that's not necessarily the case, right? We could just stay at steady state, 3% for a couple of years as well. And the rate curve is, rates aren't always right as well. Just look at how the 10 years moved. You see pretty big moves without, much changing in the economy as well. It's forward looking. So that forward look, the data that goes into pricing in that forward looking curve changes. And when people have different interpretations of that data, the 10-year, once Powell moves and people realize the economy is not going to slow down to a complete halt, maybe that changes how the curve is shaped. But for now, yes, it does appear that we could be in a strange position of having to cut rates again in 23, 24, 25.
Awesome, appreciate that. Definitely clear some stuff up.
Sure.
Thanks, Jeremy Lin, and shout out on the handle again. Greg, sorry, you've had your hand up for a while. What's going on, Greg? In Texas, you can go next.
Thanks. I'll direct this one to Jay, but anyone can answer. I've got a portfolio management question. I'm kicking myself for not cutting a bunch of stuff when it broke the 200-day decisively. And these are names I long-term believe in, like Square and SE. And so I'm just kind of curious, like, from your guys' perspective, what would you do with a name like this? I feel like, I'm now down in these positions after being up a lot, and this applies to a lot of names like Lightspeed, App, some of those as well. And if I weren't in them, I'd be looking to enter them. But now that I'm down significantly, like how do you guys think about that, dude? Like I believe that there will be further weakness. Obviously, I have no clue, like none of us do. But also, I feel like most of the damage is likely done to a number of these names. So curious how you would manage that.
It's a difficult question, and I can't really give financial advice.
It is.
Go ahead, bro.
No, I was just gonna mention one stat that I pinned above. It's 27% of Nasdaq stocks are trading above their respective 200-day moving average, and I as well own some of those names, Greg, Square and SE in specific. I know with SE, I was reading somewhere that a lot of people. I don't know if this is true. Again, I don't have stats from a broker, but I guess more people had that name than some of these growth names on market, because it seems like some of that drawdown is it's insane. And usually it's typically over the past year and a half, it's held its 200-day pretty strong, but I guess you can say that for a lot of these strong, growth names. So, but yeah, Jay, go ahead again. Like I said earlier in the call, no, this is financial advice, so these are just personal thoughts. I guess none of us can speak to buying, holding, or selling anything, but if you want to just speak overall, Jay, go for it.
Yeah, absolutely. So no one can give financial advice. Greg, we know each other. I've been raising cash since the summer, and it's for opportunities like these. Now, you need to think about what your portfolio allocation is, how much cash you have, what your age is. Some of these questions are more appropriate for a financial advisor, but don't get me wrong, some of these names are looking cheaper and cheaper, but that doesn't mean they can't get cheaper still. Apps looks very cheap. It's a great business, right? But when you think about your allocation, I think earlier, I had mentioned on a prior space, selling covered calls. I sold covered calls on a number of the names of my portfolio. I'm by no means in all cash. I'm actually relatively more invested than I want to be frank, even though I do have a lot of cash. And selling covered calls was a great strategy a couple months ago because all those calls are now almost at zero. So if you're able to do that, I wouldn't recommend doing it after such a huge crash, right? Or a correction in some of these names, even though the broad index isn't up. Some of these names are down 40%, and I wouldn't recommend selling covered calls, up 10, 15, 20%. If vol is high enough, selling them, back up 30, 40% for the next month or two wouldn't be a terrible idea, but I don't see any of those opportunities right now. It's hard to really. I think what you should be doing is making a list of the names that you have in your journal, writing why you got in, at what price you got in, how you got in, like what was the analysis you did, who you got the information from, and kind of doing a refresh of your portfolio, because there are too many people who DM me and say, well, this was my thesis 6 months ago or 9 months ago or 12 months ago. And, I'll say, well, you were buying cruise lines, right after COVID as, recovery play, but what 60-year-old, if you understand the demographics of who actually, from an income perspective and an age perspective of the people who use cruises, right, and the fact that their leverage has tripled over the last 2 years, right, do you think that cruise lines are actually valued at the same level as they were in 2019 because of the additional debt they have? Does your thesis still hold, given, all these other variants? Do you think 65-year-olds are going to flock to cruises again? And then, you said, well, no, I actually don't think so. So it's like you answered your own question. So what you can do is, go through your, Greg, we know each other. I've been raising cash since the summer, and it's for opportunities like these. Now, you need to think about what your portfolio allocation is, how much cash you have, what your age is. Some of these questions are more appropriate for a financial advisor, but don't get me wrong, some of these names are looking cheaper and cheaper, but that doesn't mean they can't get cheaper still. Apps looks very cheap. It's a great business, right? But when you think about your allocation, I think earlier, I had mentioned on a prior space, selling covered calls. I sold covered calls on a number of the names of my portfolio. I'm by no means in all cash. I'm actually relatively more invested than I want to be frank, even though I do have a lot of cash. And selling covered calls was a great strategy a couple months ago because all those calls are now almost at zero. So if you're able to do that, I wouldn't recommend doing it after such a huge crash, right, or a correction in some of these names, even though the broad index isn't up. Some of these names are down 40%, and I wouldn't recommend selling covered calls, up 10, 15, 20%. If vol is high enough, selling them, back up 30, 40% for the next month or two wouldn't be a terrible idea, but I don't see any of those opportunities right now. It's hard to really. I think what you should be doing is making a list of the names that you have in your journal, writing why you got in, at what price you got in, how you got in, like what was the analysis you did, who you got the information from, and kind of doing a refresh of your portfolio, because there are too many people who DM me and say, well, this was my thesis 6 months ago or 9 months ago or 12 months ago. And, I'll say, well, you were buying cruise lines, right after COVID as, recovery play, but what 60-year-old, if you understand the demographics of who actually, from an income perspective and an age perspective of the people who use cruises, right, and the fact that their leverage has tripled over the last 2 years, right, do you think that cruise lines are actually valued at the same level as they were in 2019 because of the additional debt they have? Does your thesis still hold, given, all these other variants? Do you think 65-year-olds are going to flock to cruises again? And then, you said, well, no, I actually don't think so. So it's like you answered your own question. So what you can do is, go through your portfolio and just think about the original thesis. Has it changed? If it hasn't changed, then don't freak out. You might see a drawdown, but unless you're on leverage or unless you're using options, you might be better off holding something. But again, it's not advice. Just you can also buy hedges. So I have kind of asymmetric hedges on names that have been blowing up. So I have a number of asymmetric hedges on SPACs. When the S1 comes due and those pipes unlocks, there's a huge redemption narrative in the SPACs we talk about at specialsitsresearch.com. You have 600 names. It's a lot. You have a couple people helping me cover them. The S1 on average comes out 40 days after the company becomes a D-SPAC, right? So the floor for a SPAC goes away 3 days before a vote. 40 days after that vote is usually a pipe. Just simple mathematics. If 90% of shares are redeemed, you have 10 million shares, and now 90% are redeemed. and you have 1 million share float, and the pipe is also 10 million shares, your float is going to increase 1,000% upon that pipe unlocking. And if you go through the pipe holders, if 50% of those are hedge funds, 75% of those are hedge funds, they're going to sell immediately. So like shorting names, like BOT, for example, and there are a handful of other names where, the downside versus upside risk reward is in your favor, in my opinion, has worked better than just shorting indices because you're never going to time the market perfectly. So that's one way that, I've hedged my portfolio. But, I know that this wasn't a perfect answer, but, hopefully it provides some, educational reference.
Yeah, that's helpful. I mean, to your earlier point, I think a mistake that I made and maybe a bunch of other people did is like a lot of the prices that these stocks moved to were not real. They were gamma squeezes. So, when Lightspeed went up to 130 or 150 or whatever it was at, maybe that was really a $70 stock. So, when it came down from 130 to 100, that wasn't necessarily a great entry is what I'm learning. So I appreciate your guys.
Some of those opportunities were the best opportunity. Like when people were buying call options, I was selling call options on those names. Like if you sold call options like 3-4 months in a row, right, you could have lowered your cost basis by like 15% plus on some of these names. It was insane.
Yeah, I mean, part of this is also with multiples, right? So if you have rates going up, the cost of capital going up, multiples are due to contract. That's kind of what you're seeing in these
The
growth
implied
names.
volatility, the upvol,
Yeah.
like the implied volatility in some of these names were insane. Like you could have sold calls at 120, 130, 150, held stock, right? These are not naked. You could have held stock. You could have sold calls up 30% from the current stock price at 150 vol and taken in, a couple bucks on a number of these names.
Yeah.
You can also use that call
just really
premium to. Sorry, Rahul, go ahead.
No. Go ahead. Go ahead, Evan.
I was just going to say, if you suspect that perhaps the market's not going to be in your favor, but you want to hold those names and the volatility is high enough, sometimes you can sell some calls to fund buying puts as a hedge as well. So there's a lot of opportunities out there to potentially blunt downside risk. Depending on what your level of sophistication and sort of risk appetite is. I mean, the easiest thing is to either de-risk, or if you're not leveraged, or if you're not using options, like Jay was saying, sometimes if your thesis is intact, you can hold through it. But there are more advanced strategies that can sometimes take the edge off a little bit, especially when you see things that you want to hold, but they're trading at unreasonable valuations on extreme volatility as well. Like one clue can be like if there's
agreed.
a huge skew.
I probably can ask on behalf of all of Intuit MM. I don't know if you have a live chart of SC or something you want to post. I'd love to kind of pin that here, just because I know a lot of Intuit is interested in that, along with myself. It's a big allocation of mine. I think we lost Texas Tech. I don't know if you jumped off, but I was going to ask you, what's your question right now? But if anyone else has a question, feel free to request to speak, and we're happy to take it. I'll post MM's chart as a pin here once he shares it. Wolf, what's going on? All right, Wolf, I give you the mic. Are you here? Weird. Twitter's giving me some errors. Sorry. Can you request again? I don't know what's going on with Twitter. Riley, what's going on, man?
What's up, Raul? Have not been on Spaces in quite a while. Been grinding out
We were just talking about
finals. Market's been awful.
You were on
Walmart
Spaces
was a
yesterday.
good play.
I'll give you a shout out. KT, were you gonna say something?
Yeah, the Walmart calls. He just got in this morning and he just kind of killed it.
I got my expirations are way farther out though. I see it having a massive move in the next, I think 3 months. I would say. I loaded up February calls for I think it's like a week after the earnings. I think that by this next earnings, they're going to show that they at least have raised prices a little bit to adjust for inflation. It's going to show, and I think they're going to pop on that. I could be wrong, but based on its peers, Dollar Tree, I think they raise 25%, something like that, their prices. I'd imagine that Walmart can up it by 5-10%, and it's going to increase their revenue annually by about $25 to $50 billion. They are the biggest revenue company on the planet, at least one of the biggest, and just a small little increase in price like that increases the margin, and they're going to have a higher net income. So I do like Walmart. I'm not really a boomer trader, but I will gladly go long Walmart here while it's kind of in some consolidation. It looks nice. might be hitting all-time highs here in the next couple months. So I kind of position myself for that. I think a lot of these bigger cap companies that are not the Apple, Microsoft, not the tech ones, but I think you got some of these 300 400 billion dollar companies that are looking like they might try and go for that 800 to $1 trillion market cap. So trying to look for those at this point. It seems like Apple might be starting to head the other direction and a nice little pullback, maybe a correction, but it's not looking good. Market has been very, very tough as of late, but I think
Yeah, man.
Luke, I think I saw you tweeted saying that you're still in cash, which is smart. It's better to wait until the waters are clear than trying to jump the gun, especially since we ripped this much. And I think that everyone at this point, everyone knows that it's pretty much a two stock market, one stock even. You have Apple who's carrying everyone, and once that goes down, then who knows where we're going to be heading. So I mean, it's tough, man. Very tough.
It is, Riley. Remember when you told me to sell Apple at 130 earlier in the year? Glad I didn't listen there.
Yeah, I'm glad you didn't either, dude. I was not expecting. I'm pissed I didn't go long Google when I wanted to. I wanted to go on Google in January. I thought that was the play of the year, and I think Walmart is going to be one of the best plays in 2022. Could be wrong, at least on the big cap side. I think added market cap.
Facebook.
Walmart can add. What?
Yeah, Meta, right?
I think Meta is going to go to. At least they have a couple of good scenarios that are going. Where one is, like the change in the ticker, which can change the sentiment on the company. The second is, like this, they might find a workaround for iOS.
Yeah.
There's
some big things going on there.
Yeah, Apple's actually my oldest position, I think. 2014, 2015. One of those years. I think when I bought
can't
it.
go long. I can't get myself to go long Apple or Microsoft at the current.
Yeah, I mean, not
right
here,
now.
but I remember at 120, 130, everyone was like, sell it.
Considering Walmart, is 0.8 sales, and, they should have at least higher margins going forward. They got to be adjusting. I think that Walmart's positioned themselves to be, one of the best buys here, especially as they, get a little bit more on the e-commerce side. And I think one of their robotics companies is going public too via SPAC. I think that was some of the news this morning. But no, I mean, I guess I'm a big Wally guy now.
Yeah, I haven't looked at Walmart too in depth, but I don't know if you're gonna write a tweet or some analysis there, Riley. But thanks for sharing. I do see he's a machine. This guy, I don't know how he does it. Not only does he get the chart up, he also shares some good commentary. So SC chart has been pinned above. Anyone has any questions, definitely you can come and ask. I think it looks like you're saying 215, 200, and 190. If this was under 190, I don't know what's going to happen on Twitter. People might lose it. But all right, that's the support levels. Jay, did you want to say something?
Yeah, just briefly. I know we've been hammering this over and over, right? But 5 stocks have been 35% of the S&P 500. If you take out Nvidia, Tesla, the 5 stocks from Nasdaq, it's only up 5% for the year. When you're talking about large cap stocks, it doesn't mean they're bad places to put capital. I mean, we pitched CBS. It was one of the easiest theses. It was a layup thesis, before they announced the $10 billion buyback. But with these large cap names, think about it, right? Like they're like 30, 40 sell side analysts covering them. It's really hard to have any alpha. They tend to be products of flows from the institutional side, mutual fund side, individual investor side. And the theses obviously can play out in your favor, but at least when I was learning and when I was training, this is a very long time ago now, my boss always told me, like, avoid, grandiose theses on the the $100 billion, $200 billion names, because, like, how are you going to have edge over everybody else?
Yep. No, thank you a lot, Jay. Thanks for sharing all that. I think we're getting flooded with questions still. I'd love to take them if you guys like to stick along. I think RD Junior, you were first.
Hey guys, thank you for this time and a lot of insight provided by you guys. So my question is, as you guys were speaking about Apple and Google, my question is related to Amazon. What do you guys see? Of course, no one has a crystal ball, but what do you guys see at a support level, and do you see it going up anytime soon for the next few months or half a year? Thanks.
I think Amazon should have done a split a while ago. They could have played that trend really well, like Nvidia did, Trade Desk did, Apple, Tesla did. But with that, I'll let some of these charting experts talk a little bit about Apple technicals. I don't know if anyone's looked at it recently, or Luca, in terms of a chart.
Sure. I mean, I think some of the price action in Apple has been driven by just an inordinate amount of options. Call buying close to the money.
I think he said Amazon, right? Was that question Amazon or Apple? Sorry, or DJ.
Amazon.
Yeah.
On Amazon. Okay, I'm sorry. I thought you said
Amazon.
Apple.
Amazon. Yeah.
So yeah, Amazon's a bit of a different beast there. This is a company that's been consolidating sideways for really quite a long time. It's kind of been a little bit of a double top potentially here. I mean, it would confirm if it broke below 3,000, let's say. But right now, it's just been kind of going sideways. I would consider it kind of trendless. Just on Ichimoku, it's just barely above the cloud, so it's technically in an uptrend, but it's below the Tenkan, it's below the EMA 8 and 21. It's just the price action has not been very constructive here. And even though Apple had not the best guidance and their shares are making new all-time highs, the opposite is from Amazon. They had not the best guidance and the shares haven't really gone very far since earnings. I mean, I had that one attempt to take out the last high. Last high was 37.73. Right now, the most recent attempt was in November, and it hit 37.62. So it really couldn't take out that last level either. So I'd say shares are a little vulnerable here. Probably what happens to Amazon also has a lot to do with what happens to the Nasdaq and the S&P because it's such a large weighting in them. Unless there's some company specific catalyst, but from a technical basis, below 3,000, and there's a significant amount of potential downside.
So I can kind of add to that. Amazon is one of those stocks that I've been trading since 2018, I guess, and the pattern that you're seeing on Amazon, it's pretty common. If you go back on your weekly or monthly charts, back in I think it was around July September, somewhere around that in 2018 to all the way to like 2019 December, it didn't do anything at all. It just was sideways. There was nothing at all that was happening. But then come 2020, that's when it kind of ripped higher too. So this is kind of a similar pattern that it also did in 2017, where like from June all the way to like September October timeframe, it was just sideways, didn't do anything, and once from November onwards, it just started ripping higher. So it's kind of
just barely above the cloud, so it's technically in an uptrend, but it's below the Tenkan, it's below the EMA 8 and 21. It's just the price action has not been very constructive here. And even though Apple had not the best guidance and their shares are making new all-time highs, the opposite is from Amazon. They had not the best guidance and the shares haven't really gone very far since earnings. I mean, I had that one attempt to take out the last high. Last high was 37.73. Right now, the most recent attempt was in November, and it hit 37.62. So it really couldn't take out that last level either. So I'd say shares are a little vulnerable here. Probably what happens to Amazon also has a lot to do with what happens to the Nasdaq and the S&P because it's such a large weighting in them. Unless there's some company specific catalyst, but from a technical basis, below 3,000, and there's a significant amount of potential downside.
So I can kind of add to that. Amazon is one of those stocks that I've been trading since 2018, I guess, and the pattern that you're seeing on Amazon, it's pretty common. If you go back on your weekly or monthly charts, back in I think it was around July September, somewhere around that in 2018 to all the way to like 2019 December, it didn't do anything at all. It just was sideways. There was nothing at all that was happening. But then come 2020, that's when it kind of ripped higher too. So this is kind of a similar pattern that it also did in 2017, where like from June all the way to like September October timeframe, it was just sideways, didn't do anything, and once from November onwards, it just started ripping higher. So it's kind of a very similar pattern with Amazon, and when it starts moving, it just keeps moving. Coming to the support levels on Amazon, I think we are hitting at close to a support level there at 3370. If we break below 3070, I think we have a little bit of room to 3175, 3150. And if we lose that as well, I think we can go all the way to 3000. 3042, 3040, and under that is like 2950. So, but again, that's like the lowest swing that you can go with this sideways consolidation that we are seeing since July. Actually, no, not July. I would say August of 2020, right? So that's mostly about Amazon, and other part of Amazon is like most of I think I talked to Rahul the most on this panel. So I sold a major stake of my Apple position recently at 170 and I'm waiting on the sidelines to load up into the next thing, right? So Amazon to me has a couple of things that can happen for the move like it did after that huge sideways pattern that we have seen in 2018, 2019, and the same kind of sideways pattern that we have seen in 2017. Those couple of moves might be AWS spin-off and a retail spin-off, where like there's a major unlock if they really do that. I really don't want a split. I want something like that, where how Google has spun off Waymo or something, or Intel has spun off mobile. I think that to me is the biggest thing that I would want to see as an investor. So that's I mean. I'm not long Amazon yet, but these are my speculations that why I want to go long on Amazon. The second is the split. Like why stocks run up on a split? I have zero clue. I mean, it's kind of absurd to me.
I think it's just the psych, honestly, the psychology, and also the amount of
I mean,
participation you get from retail. Obviously, is one part of it, but I think there's also certain, I guess, funds that can add it based on different methodologies. So, but there's no change in value, so there's no math reason behind it. You're 100% right.
I mean, actually, the
yeah, I
companies
mean,
lose money on splits, which is kind of funny.
I mean,
Technically, because it
technically, right?
costs
Like,
money.
if Amazon splits, like there are some, like what Rahul just said, right? Like like Dow is price
It's a
weighted.
price weighted index, so you change
Exactly.
you
So
can't
so
do
there are certain
manually.
things
Yeah.
around that, but it really doesn't make sense about the retail participation to me at the current scenario in
Yeah,
the
you
market
don't
we are
do
at.
it. Yeah, you don't do it for retail, but I think retail bids it up. I mean, again, it's not a big change. Retail can't move a stock, person
Well,
like
I mean,
as a
you got
whole, but
the fractional shares now too.
the
So I mean,
fractional
it's
shares and also the options. Remember one thing, right? So people like that get 100 shares now. If it splits, more options activity happens. Also, I think. I mean, look at Tesla. We talked about earlier in the call, right? So look at all those people that were probably invested in Tesla since 20. I mean, the amount of wealth Tesla has created is insane, right? In the past decade. So those type of splits. I mean, I agree with you fundamentally. There's really no reason to do it. But to that point, though, Apple actually in 2014, KT, if you remember, like I said, Apple's one of my first positions ever. They split that stock. It was 7-1, I believe. I'm pretty sure 7-1.
Yep,
I'm not even.
it was.
I don't
Yep.
have a computer. I don't have a computer in front of me, but I'm pretty sure it was 7-1. Because I think that's when I bought right after split in the 90s at that time. So the split price now, like, I think it's like 34, 33. But that was done because of the Dow Jones inclusion. And I remember all this because I had just started out of college at Bloomberg. And ironically, I worked on around index data and I moved into the index product side at Bloomberg for the 8 years I was there. So I remember actually, seeing that split happen, us reacting to that because we're inflowing the data from S&P Dow Jones, and then Google split happened right around that time too. It was a 2-1 right when they became Alphabet. I think it was 2015. Same thing, 2-1. I think it was like $1,000 or something. The price might have been. It split. It became 500-600, and I mean, you didn't see a rally right after kind of some of the stuff you've seen recently in the past year or so. But the split, I think you can argue, did help at that time. I know for Apple, it was one of the reasons was the Dow Jones. And when that happens, when you get added to these funds, as I mentioned, the funds that are hedged against any of these indexes, that generates kind of capital into the company, right? So you kind of see, I think we haven't touched on this in this call yet, but QQQ is going through a rebalance December 17th, right? And a lot of people, I guess, questioning why Lucid made it, which I find pretty funny. I mean, I'm a holder and believe in the company, but it's pretty crazy to me that they made it. But Airbnb made it, as well as Zscaler and Datadog, and I think another company, I forget the
Palo
name,
Alto.
with the F, yeah, Palo Alto, and there's another one too.
Fortinet?
Yeah,
Fortinet.
yeah, that one. Yep, that's the one. So yeah, that's coming up. So it is very important to understand kind of these inclusions as well, in terms because all these things, they affect narrative, they affect fund flow, they affect kind of psych levels, just human psychology, as well as psych levels on the company's price. So sorry, I just went on a tangent there. Go ahead, KT. Sorry.
No, that's good. I mean, yeah. I mean, that's the two catalysts that I see from Amazon at the moment for me to go invest into it. But for the upside, though, like if we are looking at 550, 3550 break, I think we will see 3700, 3800 again on Amazon. Today also, I think there was a Cohen kind of upgraded it to 4200 or 4800. I forget what the price target was, but. They did give out their points as well. I can share that. I'm sorry. All right. Yeah. That I think I think 35.50. That's the level to watch on the upside.
Thank you, guys.
You're welcome. Thanks for joining. I think Brandon, you're waiting for a while. What's going on?
Yeah, sorry. A lot of my questions have been hit, but I did want to kind of maybe change the scope just a bit. I'm loving everything that I'm hearing, and I appreciate everybody's input and their time. As someone who has just recently kind of got into the markets, investing, um, I feel like there's a ton of information out there with day and swing trading, pattern trading, and then of course there's tons of information out there on investing in general. But to hear some of you talk about the markets as a whole and kind of the macro scope on how everything works together, does anybody have any type of resources that would be a great place for somebody new to kind of get a real good grasp of the macro environment?
I'd send you to MM's website. We actually posted a recording, or sorry, not posted a recording. We plan on posting a recording. We had a space yesterday morning, 3+ hours. One of the questions that I asked our speakers to talk about was the tools that you guys use. So, KT, do you want to reiterate some of the tools you use? And MM has a website. I'm not joking about this. It's pretty helpful. So that's definitely one place you can check out. But KT, I think you went in a little bit deep in terms of tools. That you do use because you're trading a lot more actively.
Yeah, like with respect to the macro, I'll just answer that in general, like as to how when starting to invest, how do you approach your trading? The first thing that many people try to focus on when they start out trading is trying to figure out what the technical analysis is, the patterns, and what are people talking about, Elliott wave theory, fibs, support resistant levels, VWAPs, things like that. But the most important thing about trading is about understanding your risk and understanding the reward. So that I think is one of the main thing that you have to focus on when you start investing or trading. But otherwise, so coming back to the tools that I use, I kind of use TrendSpider and Tradelytics. These are the two platforms that I kind of use the most. And for macro, I just like Walter Bloomberg. He's a free Twitter out there, and every news just comes out onto my Discord. And the news, especially with respect to the stocks that I'm watching, or with respect to the politics and the policies that are that are given out, I just note them down in my notepad, and I kind of note them with respect to dates. So on a given date, the news has already come out, but I when I come up to trading again, I just go through my notepad and say, okay, this was announced before. Is it happening, or why is nobody talking about, or something like that? Like I kind of review those notes over and over again, for because I'm kind of a short term trader too. So I kind of review them on a weekly basis and try to figure out and position myself to those macro events that are going to occur. Um, but yeah, I mean, those are the three tools, and I just try to keep everything very simple with respect to my trading. So that's about it.
Thank you.
You're welcome, Brandon. And we'll post that recording from yesterday as well. It goes into some other traders as well that we had, and tools and techniques they use. So we'll definitely put that on the Pounding the Table YouTube channel. Luca, that's on you when I send it. But I'll send it to Luca probably this week. So that was like a 3-hour or 2-hour session we ran yesterday. I think next we had RAS. What's going on?
What's going on, man? How's it going?
What's up, man? Thanks for joining. Do you have a question?
Yeah, thank you for having me on. I was just,
of course.
I was just wondering if you've heard about Spatial. Is a marketing tool I've been using with my colleagues. We're in the NFT scene, and it's pretty much 3D Spaces, which was pretty much originally made to kind of host business meetings, etc. But it's all in VR, and you can make like custom maps and pretty much maps for up to 50 people can join, and kind of host events and host kind of meetings and social gatherings, and I just wanted to kind of share it with people because it's a free tool to use. You have to pay any membership to use it, and host kind of maps and share them with people. But it's quite an interesting tool. I just wanted to share with you guys.
All right, cool. Well, if you'd like to check that tool out, go check out Rass's, I think, Twitter page. With that, I don't know if we have any more pending questions. Looks like we've answered a good bunch. We've gone for, I think, almost 2 hours. So thank you, everyone. Thank you for joining. I hope this was helpful. As I mentioned earlier, our next spaces, I mean, these are spontaneous, so this wasn't planned at all. Thanks for joining. If you found this helpful, definitely tune in again. We'll be hosting these a lot more. We have one planned on Wednesday, as I mentioned, at 6 p.m. It's on Pounding the Table, the tweet. I pinned it above as well in terms of and we'll share a link for a reminder. Our following one after that will be with Sawyer Merritt, talking Tesla specifically. I'd love to have on a lot more, just talking more markets and macro. He's been on with us the past few days, and that's been incredible hearing from him. But with that, I mean, I think we'd like to wrap it up here. Give everyone the panelists a follow. If you enjoyed this, if you liked hearing from everyone, you've got Pounding the Table at Markets Mayhem, Problem, Sniper, Luca, and Riley. And I'll be hosting these a lot more. I mean, I think I've probably hosted like 8 or 9 of these already this month, and they've all been, I think, gone pretty well overall. So give everyone a follow, and hopefully you found this helpful. Thanks a lot, everyone. I don't know if you have anything to close, or KT or Luca, but I think that's it for mine.
Yeah, I mean,
Thanks a lot, Rahul.
Thanks for having me, Rahul, and thanks everyone for tuning in. Definitely would be happy to join in more often. Really appreciate all the great feedback, and to everyone who's listening, just be nimble. This is a really important week, and it could, to some degree, shape the first quarter of 2022. Some of the things that are happening here with regards to expectations from Fed policy, sentiment, some of these important levels that we're at on the markets, options positioning going into quad witching, and where we are. I mean, we've really got to try to hold about probably 4620 on the S&P to try to avoid slipping and retesting some of those November lows and some of those December lows. So, overall, it's a choppy week. It's probably going to be more volatile than normal, especially underneath the surface of the indices and some of these individual shares. So, if you're not used to trading a really choppy market, there's nothing shameful about just watching from the sidelines. And if you're investing, maybe be careful about your risk appetite unless you're buying things for the very, very long term. Of course, if you're dollar cost averaging in, which is probably the best thing for a lot of investors to do, then just keep on your program and manage your risk accordingly. But overall, there's no one perfect strategy for anyone. So make sure that you're spending time doing something that works for you, for your goals, for your age, for your risk tolerance, and really try to shape that and learn more about how to invest and how to trade over time. And the best investment we can ever make is really going to be in ourselves.
Awesome. Thanks, everyone. Thanks for tuning in. Thanks, Aman. Thanks, Luca. Thanks, Rusty. Thanks, KT. Awesome. Thanks, everyone. Thanks for tuning in. Thanks, Aman. Thanks, Luca. Thanks, Rusty. Thanks, Rusty. Thanks, KT.
Y'all on level 1, I'm level 3. Pounding on the table for my team. Every night I flex, I'm making big moves. That's a big move.